Hey guys, John Paulamy here, Actionable Intelligence. Today's Saturday, June 2nd, 2018. And I wanted to do a video on different ways or a way to play what I see is going to be the downside in these markets that is eventually going to hit. And I've been contemplating, we've seen for the last 10 years a liquidity-driven, central bank-driven bull market in all assets. And I think it's safe to say that we see overvaluation and bubble-type conditions in quite a few markets, specifically the stock and bond markets. So if the thesis or view is that the stock market returns and bond market returns that people have enjoyed for the last decade have been predicated upon central bank loose monetary conditions, then it would stand to reason that as the Fed and various other central banks around the world begin to tighten liquidity conditions by raising interest rates, that we could see a reversal of those conditions and eventually see a decline in stock prices and bond prices. So I think every crisis or crash or downside event is usually different than the previous one. It's never really the same, although the conditions that create the downside or the crash or the drawdown, if you will, are usually based upon Fed policy. And I want to show that in the next slide. So this is off the St. Louis Fed's data page. It's called Fred. If you are wondering, wanting to know anything about any economic stats or graphs or anything, they have pretty much everything on there. But that's where I got this chart. So this shows the Fed funds rate. And as you can see, the blue line that's looks like an EKG is the level of the Fed funds rate in percent to the left, and time frames from 1955 till present along the horizontal. The gray shaded areas are areas where those are recessions, times of recession. So as you can see, looking at every recession, they were pretty much preceded by, and I would suggest to you, created by raising interest rates by the Federal Reserve as a methodology to ostensibly control inflation, which basically raised the cost of borrowing and creates these recessions. And then as you can see, after the recession or during the recession, a rate cutting cycle then ensues. You have an expansionary period until the same conditions are recreated, and another rate raising cycle goes into effect, rinse and repeat. So, as you can see, from 2005 to 2008-9, there was a rise in rates, and this led up to the most recent recession in 2008 and 9, which was the Great Financial Crisis. So, we are in the midst now of another rate-raising cycle. So what I am going to suggest is it's time to begin to think about at what point, if the Fed continues to raise rates, and they have indicated that they will continue to raise rates, at what point does some event or something occur, something that breaks financially that causes the next financial crisis? And I believe that the next financial crisis is going to be specifically in the sovereign and corporate bond markets. Now, last week when I talked about gold, I already talked about the amount of indebtedness that the United States has, the unfunded pension liabilities, the state pension liabilities, the different debts in the emerging markets, which are almost $65 trillion. We saw last week in the markets, as the political crisis in Italy intensifies and you have more and more of an anti-EU stance being taken, the sudden rise in bond rates in Italy, and Cracks, tremors. I mean, we used this analogy in a previous video, guys, where I talked about, before you have a major earthquake or a major volcano blast off, there's usually a lot of pre-tremors and pre-indications seismically that something is getting ready to happen. And I think that's what we're seeing now. If you probably don't recall, but you may have, several months ago, Toys R Us went bankrupt because they couldn't roll over their debt, $400 million in debt that they had of a total of about $4 billion. They couldn't roll it over, and then the whole thing just imploded, and the company ended up declaring bankruptcy. And I think that's a precursor of what we're going to see across the corporate environment as rates continue to increase. So here's a chart of corporate debt to GDP. As you can see on the far right, we are right back to almost all-time highs. And if you look at previous highs, you will note that they are right around the times of previous financial crisis, i.e. 2008, you can see right here, and back in 2000. So these also coincide with Fed fund rate, interest rate increases by the Fed cycles. So as the Fed increases rates, a lot of these corporate entities that are in severe debt, they have to roll over their debt or try to renegotiate it, or their debt interest rate payments are tied to the some type of interest rate instrument that's going up going up, and they just are unable to make the interest payments or unable to roll their debt, and then the whole thing comes apart at the seams. We've seen that before, 2008 and 2000, and all the way back in 1990. So this is not going to be the first nor the last. So why I'm bringing this up, guys, is because this is going to create a crisis. This is going to create the chaos that everybody's looking for, in my view. But for the average schlub out there, or the average schnook, they're the ones that are going to pay the penalty. They're not going to understand what's happening again. This is why I'm talking about this now. I mean, right now, if you watch the news, everything's hitting on 16 cylinders. Unemployment's real low, blah, blah, blah. The propaganda is flowing. So the underlying ice, though, is not as thick as people think it is, and they're walking around on thin ice. And we know from studying history, we know from looking at the past, that these companies are very weak. They've taken on a lot of debt because of 10 years of very, very low interest rates and high liquidity. And now, as the cycle turns and rates increase, as Warren Buffett says, we're now going to see who's wearing swimsuits because the tide is now going out. So the problem, of course, with all of these crises, if you will, is it's just an accumulation of too much debt. And it's just a cycle that rinse and repeats itself over, 5 and 10 year periods. So these are just some facts that I want to throw out there. S&P estimates that there is $4.4 trillion in corporate debt that's going to mature between now and 2022. $1.3 trillion of this debt is junk. It's in junk status. It's below investment grade. $1.3 trillion. That's back to the Toys R Us example. And rolling debt over when interest rates are at 5,000-year lows is not hard, because they're basically, the rates were at zero. Now that we're into this rate-raising cycle that's being indicated to us, at least by the remarks that the Fed's making, is going to continue. Every time that somebody goes to roll over their debt or try to refinance, they're going to be trying to do it at higher and higher interest rate levels. And obviously, that will become more difficult for a lot of these companies that really aren't viable unless rates were near zero. So a decade plus of low rates have created an unknown amount of zombie companies. The IMF estimates that 20% of U.S. companies are at risk of default. So this is where I believe it's going to start, guys. This, and in the sovereign. When I say sovereigns, I'm talking about country debt. We're already starting to see some of that in the emerging markets with what happened a few weeks ago in Argentina and a couple of other countries. Some of the emerging market countries are down pretty drastically, their stock markets, One of the companies that I am in, or countries I'm invested in, is Nigeria, and it's off about 10% over the last month. So higher interest rates are not good for highly indebted people, companies, or countries. I mean, that just goes without saying. So we know the Fed is now firmly in a rate raising cycle and will keep raising rates until something breaks. If they, that's their typical MO. I mean, they have this hammer, this huge hammer for, it's called, being able to control short-term or Fed funds rates, which ostensibly influences all the other interest rates. The bottom line is that as they raise rates, it's going to cause other rates to go up, and at some point, like I said, these 20% of companies that are zombies walking around, they're just not going to be able to roll their debt, and they're going to end up like Toys R Us going bankrupt. Now, that's going to be bad for a lot of people, because as the bond market rolls over and companies start going bankrupt or can't roll their debt, this is going to create a change in perception and sentiment that's going to bleed over into the stock market, I believe, and cause stocks to decrease too. So I don't know when this is going to happen. Of course, all of this is timing. We don't know. It's like sitting on a, big bunch of crates of dynamite, and there's a fuse that somebody has lit, but we don't know how long the fuse is. We know it's going to blow eventually. We just don't know when. But we have the ability to at least understand from the past what has happened as over-indebtedness has turned into crisis because of rising interest rate cycles. So we know it's going to happen. We just need to monitor it and be able to understand what's happening and then take advantage of it. So here's a quote from Moody's that came out a week or so ago. They've been studying this exact phenomenon that I'm talking about. They said, this is a quote from a report, "This extended period of benign credit conditions," they're talking about the last 10 years, "has helped many weak, highly leveraged companies to avoid default. These companies are poised to default when credit conditions eventually become more difficult." And that's right from the credit monitoring service of Moody's, if you want to believe it or not. But that's I agree with that assessment. So here's a chart of HYG, which is an ETF of high-yield corporate bonds. And this goes back to late 2013 till recently. And as you can see, the high-yield bond market appears to be topping out and rolling over. This is one of the indicators I suggest that we watch, because obviously as rates go higher, bond prices go down. And here's what I think is the opportunity, guys. Right now, we just need to watch this. I wouldn't commit cash to this right now. So basically, or I certainly wouldn't buy this, because this is only going to do well if corporate high yield bonds go up in value. But we obviously, with rates going up, we expect the value of the bonds to go down. But I just wanted to show this as an indicator as this thing rolls over. And this is one of the indicators we should be watching to see as a trigger. As this thing starts to drift down or break, if it breaks lower and breaks that little sideways side to side there, topping area, like a drop to 82 or 80, that would be a good indication for us that the bond market and the high yield is falling apart. So this does not look positive to my mind. I would not be getting long this chart. Now, what I think is going to happen also, why I think there's a big opportunity, is because people don't understand this about bonds. And I have bought bonds. I own bonds. I play around in distressed markets with bonds. It's very difficult. The liquidity in the bond market and buying and selling bonds is a lot harder than buying or selling stocks. I mean, if you want to buy 1,000 shares of some company, you just go on Ameritrade, enter the trade, hit buy, and it's almost instantaneous if it's a market order. Even though with a limit order, you can pretty much get filled fairly easily, with most stocks trading on the NYSE and the NASDAQ. I mean, obviously there's penny stocks and some of these over-the-counter markets where the liquidity is not as good. But I'm talking about general stock trading. If you want to buy, 100 shares of Tesla or 50 shares of Microsoft, you can do that instantaneously. And a market's being made, the liquidity is sufficient that the trade will get done without too much of a movement in the price of the stock. That's not how it is in the bond market. Bonds are very opaque. Their pricing, you can do them online, but a lot of times you have to call the bond desk and put in an order. Sometimes it's very difficult to get the orders filled. They have to try to go match the orders by calling around. So what I'm trying to get at is that if we get in a situation where we get into a liquidity crisis, which is what I think is going to happen, and people go to sell bonds en masse because interest rates are going up, or they think that the bonds they're holding in a certain company, XYZ, is a zombie company and they're not going to be able to roll their debt, what you're going to see is big gaps down because there's just not going to be liquidity there. No one's going to be there to buy these bonds. Or if they do buy them, they're going to be at a substantial discount to what the person that's selling them bought them for. And another thing you have to remember is if you have this ETF like this HYG, people can trade this ETF. It's a stock. It trades like a stock on the stock exchange. So people will go in and try to sell it. And this forces the manager of the ETF to go in and then try to sell the bonds to match the amount of sells of the ETF. And there's just not going to be liquidity. So when this thing breaks, I suspect you're going to see big gaps down. And that is going to be tremendous. And that is going to create a sentiment and perception that is not going to be conducive to positive moves in the stock market. I can assure you of that. So when things are orderly, when things are not in crisis, it's not really that difficult to buy and sell these bonds. But if liquidity is tightening up, which it is now with the Fed raising rates, and if perception and sentiment changes to the negative, which is what I think is going to happen, and it could just happen overnight. I mean, you have an election like in Italy, or you have them, just say, for example, Italy was to say, well, we're going to get out of the euro, or we're going to create a dual currency, or we're going to push for reneging on our debt that the EU has bought, or whatever. I mean, this could cause a crisis. So I don't know, and I don't think it's easy or even worth thinking about what is going to be the black swan event that kicks this thing off. But with the strangling of liquidity, when we do get the event that sets off the dynamite, I think it's going to happen quickly, and it's going to really reverberate through all the markets. So this right here is another ETF, which is the ProShares short high yield. So this is basically an ETF that shorts high yield junk debt. And you can see right now it's building a base. So basically what we're saying here short is that if bond prices go down like we're thinking, then this ETF will go up. Okay? And this is the one I'm watching that I will be using to play the downside in the bond market, because if bonds interest rates keep going up and bond prices go down and we have a liquidity crisis and this high yield debt rolls over, can't be rolled over, and these zombie companies start tipping over and going bankrupt, we should expect to see the price of this ETF go up. So we'll be looking for a technical breakout here to be consistent with the fundamentals and the news flow of seeing more and more Toys R Us type situations. So this is something to watch. So as I said earlier, this debt debacle, which is what it's going to be in my view. I mean, I talked about it last week with the gold market video, or why you should own some gold. I talked about all the sovereign debt out there. I've talked about the unfunded liabilities. I've talked about the pension schemes that are underwater. I mean, there's just a whole gamut and plethora of problems. And it's all been swept under the carpet, covered up, and not resolved, and been hidden by the fact that we've had, like I said, interest rates at 5,000-year lows. And that's changing now. And as rates go up, we are going to see where the real problems are. They're going to start popping up like whack-a-mole here before too long. So I think, it's very hard to go in like short stocks and know when that's going to happen. I think this is really going to be the way to play this next cycle, because typically what happens is when we go through these crises or these down cycles, typically what happens is the bond market rolls over first, then that bleeds into the stock market then rolls over, and then eventually commodities roll over and go down. So I think to take advantage of this increase in rates that's going to continue, and that's going to, in my view, cause a debt crisis, it behooves us to watch and wait. Like I said, I think this is a when and not an if event. This is going to happen. It's happened before in the last 2 rate tightening cycles. I believe the same thing will happen now. And the thing about it is, guys, is that if you read like Steve Blumenthal, I mean, he went through a couple of these cycles too, and this is actually going to be an opportunity for people that know what is going on, because as the price of bonds collapse in the corporate market and a lot of companies go bankrupt, there will still be companies that don't go bankrupt, but their interest rates on their bonds are going to blow out. And in the last cycle, it was not uncommon to find bonds of surviving companies that were yielding 20 to 25% yield to maturity. So it's going to be a tremendous opportunity after the crisis, because the world's not going to end. The sun's not going to, exhaust its hydrogen fuel, and we're going to be, consumed by a red giant. Things will go through their cycle. A lot of dead weight will get, cut off, and what's left will be tremendous value. And I think if you look at it from that perspective, then you won't be the ones that get taken advantage of, because the average person will not have a clue what's going on. I mean, I just showed you these charts, or this chart back here. I mean, we've seen this cycle before, and as things cycle down, I mean, there's an opportunity to buy at these bottoms, and that's what we're going to want to do. So this is a cycle that's probably going to play out over several years. And though it's not like something we have to get all nervous about and get our trigger finger, but it's something to watch. I think I wanted to bring it up because I think it's going to be the catalyst that brings the whole thing down. These rising rates, if they continue to raise rates, the history of the Fed is they raise rates until stuff breaks. They're always behind the curve, and something's going to break. It's emerging markets or something in the EU, or enough certain companies in the US start tipping over. It's going to be something that drives it. And I think one of the things is going to be the rising oil prices that I've been forecasting. It's really going to scare the Fed into thinking that inflation is really going to get out of the bottle. And, I am forecasting over $100 a barrel oil by the end of this year or early 2019. I think that's going to worry a lot of people, and that's really going to push the Fed to continue raising rates. And like I said, we know what that outcome means. So I think it's something, this whole debt, corporate debt, emerging market debt, sovereign debt of the developed world is something to watch. I think it doesn't need to be something we worry about. It's something we can take advantage of and we can make money on. And that's what we're all about doing here. So the average person is going to get consumed by events. We're going to master the events and turn them into opportunity. So that's the video for this week, guys. I hope you enjoyed it. I hope I wasn't too opaque or talking over people's heads. Let me know in the comments if there's any questions. Appreciate the viewership. Hit that subscribe button, guys. Help me out, and forward this on to your friends. And I really appreciate the viewership. Thanks a lot, and we'll talk to you next week.